You have two credit cards in your wallet, same name on the front, same magnetic stripe, same chip, same monthly billing cycle. To you, they are just two pieces of plastic that buy things, but to the bank, they are not the same product, not even close. And the difference between them, a difference you cannot see, a difference nobody told you about at sign up, is the reason one of these cards will quietly carry you through a tight month, and the other one will hand you a charge-off. Welcome back to Sense and Simplicity. If you are new here, I spent over 20 years in banking across major banks, regional banks, community banks, and a credit union as a branch manager and a district manager. Quick note before we get into it. This video is general education, not financial or legal advice. Every situation is different and laws vary by state. If you are facing a lawsuit, garnishment, or a specific legal matter, please consult a licensed attorney or your local legal aid office. The story you will hear today is drawn from real experience, with names and details changed to protect the people involved. Here is the thing nobody explains when you sign up for a credit card. The piece of plastic is the same. The Visa or MasterCard logo is the same. The way you swipe it at the register is the same. But underneath that, every single card has its own private settings, its own interest rate, its own credit limit, its own grace period, its own penalty rate when you miss a payment, its own fee schedule. Two cards in the same wallet can have completely different settings, and those settings are what determine whether the card survives a hard month or destroys you in one. Let me tell you about a customer I worked with a few years back. I will not use a name. I will not tell you the institution. The details are changed enough to protect everyone involved, but the shape of the story is real, and I have watched it play out, in some version, hundreds of times. This person came in to talk about their credit report. They had two open credit cards, same wallet, both opened within the same year, both carrying balances. One of them was current, the other one had just charged off. Card 1 was a major bank credit card, standard interest rate for someone with their credit profile somewhere in the high teens, a grace period that gave them about 3 weeks between the statement closing and the due date, a credit limit of about $10,000. Card 2 looked like a credit card too, same logo on the front, but the numbers under the hood were different. Higher interest rate, well over 25%, a smaller credit limit, around $2,000, and a much tighter penalty structure if a payment slipped. Then a tight month happened, the kind of month most people have a few times in their life. Car broke down, some unexpected medical thing, a larger than normal utility bill in the same window. Their checking account got squeezed harder than usual that month. They paid what they could. They paid the major bank card almost in full. They paid the minimum on the second card. They thought, I will catch up next month. Most people would think the exact same thing. That is a normal response to a tight month. And here is what they did not see coming. On the major bank card, the interest charge that month was modest. The minimum payment they made was enough to keep the account in good standing. The card kept reporting current. Life moved on. On the second card, something very different happened. The interest rate that was already over 25% kept compounding. The minimum payment they made barely covered the interest, and the principal balance actually went up that month, even though they paid. The next month's minimum payment came due, and it was bigger than the one before. That is when the trouble started. The next month came. The customer looked at the statement on the higher rate card. The minimum payment had jumped because the balance had grown, because the interest from the prior month had been added. They tried to make the minimum, but it was higher than they could cover. They paid what they could. It was not enough. The card was now 30 days late. From there, things moved fast. 60 days late, 90 days late, the penalty rate triggered, the interest charges got worse. By the time we sat down at my desk together, that card was past 180 days, and it had been charged off. Here is what I want you to understand. The customer did not do anything reckless. They did not blow off the bill on purpose. They made the minimum payment in the first tight month. The reason one card stayed current and the other one charged off is not because the customer treated them differently in that first month. It is because the cards themselves were not the same product. The higher rate card had no margin. One tight month put the balance in motion, and the next month's minimum was bigger than the customer could cover. From there, it cascaded. Different interest rates, different fee schedules. Those terms were in the cardholder agreement, but nobody walked the customer through what they actually meant. Inside any credit card issuer, there is a process called risk-based pricing. It is not a secret, it is in their public filings. When you apply for a card, the issuer looks at your credit profile and routes you into a category: prime, near prime, or subprime. The category you land in determines what kind of card they offer you. The interest rate on that card is set to match the expected loss rate for that category. In plain English, if the issuer expects more people in your category to default, the rate they charge the people who do not default is higher to make the math work. What that means for you, the cardholder, is that the bank decided what category you belonged in before you ever swiped the card. Your interest rate, your credit limit, your penalty rate. All of that was set on day one based on where the issuer placed you. If you ended up in a higher risk category, even by a little, the card you got is built differently. Not worse, not predatory, just priced and structured for a different loss profile. That is not a moral judgment. It is just a business model. So how do you tell, looking at your own cards, which category each one belongs to? You do not have to call the bank. You do not have to be an insider. The information is right on your statement. Look at 4 numbers: the standard purchase APR, the credit limit, the penalty APR, the rate that kicks in if you fall behind, and the late fee. As of early 2026, the average credit card APR is right around 21%, so that is your reference point. If your APR is in the low 20s, your credit limit is several $1,000s, and your penalty APR is well below 30%, that card is probably prime or near prime. If your APR is 26% or higher, your limit is small, and your penalty APR is close to $29.99, that card is in a higher risk category. It matters which category your cards are in because the same tight month does not affect both kinds of cards the same way. A higher APR, smaller limit, tighter penalty card has almost no margin for a missed payment. The interest compounds faster, the fees are larger relative to the balance, and the penalty rate can push the balance up even when you are paying the minimum. A prime card gives you more room to stumble and recover. A higher risk card punishes the same stumble much harder. If you carry one of each kind, here is the practical playbook I gave that customer and have given many others. Number 1, in a tight month, prioritize the minimum on the higher APR, higher penalty card first. That is the card most likely to spiral. The lower APR card is more forgiving. Number 2, if you can pay extra on any card, pay it on the higher APR card. The math is brutal there. Every dollar of principal you knock down saves you more in interest than the same dollar paid on a lower rate card. Number 3, if your credit profile has improved since you opened the higher rate card, call the issuer and ask for an APR reduction. They sometimes say yes, it costs you nothing to ask. Number 4, if the higher rate card is from a store or a private label issuer, look at whether you actually need it. Closing it has credit score implications, so do not close it without thinking through the impact, but you can stop using it. Number 5, if you are already behind on the higher rate card, do not panic and do not ignore it. Call the issuer. Ask about hardship programs. Most issuers have them. They are not advertised, but they exist. The customer I told you about at the start of this video, here is how it ended. The lower rate card stayed open and current. They kept it. The higher rate card had already gone past 180 days and charged off by the time they came in to see me, so we could not save that one. But we built a plan for what to do about the charge off, what to expect on their credit report over the next several years, and how to make sure the next card they opened was a different category than the one that hurt them. That is a different conversation, and one I have made other videos about. If there is one thing I want you to take from this video, it is this. The card you carry is not just a piece of plastic. It is a contract that already decided how it will treat you when things get hard. Most of the time, when someone defaults on a credit card, it is not because they were careless. It is because the card they were carrying had no margin for a tight month. If you want to understand what happens when one of those cards actually charges off, what the bank does, what the timeline looks like, and what shows up on your credit report, I made a full video on that. It is called Credit Card 91 to 180 Days Past Due, and the link is in the cards above. If this video was useful, hit subscribe. The more people who understand how these cards actually work, the fewer people get caught off guard by a card that was never going to be forgiving in the first place. I will see you in the next video.